hello, and good morning. Welcome to Governance Week 2026. I'm Kamala Rampersad de Silva, Chief Executive Officer of the Caribbean Corporate Governance Institute. And it is my absolute pleasure to welcome you to our fifth and final day of Governance Week 2026. I would like to introduce our presenter, Robert Riley. So you will have his agenda in the his full bio in the agenda, but I'm happy to share a lot more about him because there's a lot to say. So Robert Riley is an independent, non-executive director. He was elected chairman of the board of Massy Holdings in May of 2023. He previously served as deputy chairman of the board of Massy Holdings Limited and chairman of the company's governance, nomination, and remuneration committee. He has also served in a variety of executive management and senior legal positions over the years, including head of safety and operations, safety risk leadership and culture at BP PLC in London, and chairman and chief executive officer of BP Trinidad and Tobago. He was vice president, legal and government affairs at Amoco, BP Amoco, and general counsel and corporate secretary at BWIA. He has also served on the boards of Amoco Trinidad and Tobago LLC and other Amoco entities, Titan Methanol. He served at BP Trinidad and Tobago, Atlantic LNG, the Bank of Nova Scotia Trinidad and Tobago Limited, the University of Trinidad and Tobago UTT, Caribbean Airlines, which BWIA was the forerunner to, and he has also served on the board of management of J.D. Celia and Company's attorney at laws. He is an attorney at law, admitted to practice in 1987. He holds an LLB honors from the University of the West Indies and Barbados, BSc honors in agricultural sciences from the University of the West Indies, St. Augustine. In 2009, he was awarded a Doctor of Laws honoris causa by the University of the West Indies in St. Augustine. And in 2003, he was awarded a Shakonia Medal Gold by the government of Trinidad and Tobago for his contribution to national development. We are always so pleased to welcome you to CCGI, Robert, and I'm just thrilled that you are presenting here for us for Governance Week 2026. And so I'm happy to hand over the virtual floor to you for your presentation as we look at governance in a volatile world with a focus on groups and conglomerates.
Thank you all, and good morning, and thank you for those kind words, Kamla. It's a real pleasure to join this esteemed panel of presenters, and I hope that I can at least start the day off with a good array of things. Let me try and put some slides up. It's not my usual style, but I'm learning. This old dog is learning a few new tricks. So let me see if I can share my slides now with you. Where have I gone? Okay, I've gone over here. You're sharing.
Yeah, so we're seeing your desktop at the moment.
Right. Okay. Are you seeing my screen? Are you seeing the screen yet? No? It's a lovely screen, I know. Thank you. Okay, what have I done wrong now?
Okay. Hi, Mr. Riley. So if you just
play.
stop share, and then
Yeah.
when you click share, you would be able to individually select which window you want to share.
Okay, stop share.
Yeah. Then make sure the PowerPoint is open.
Yeah, it is open.
Right.
Have I stopped share now?
No, not yet.
So I've stopped share there. Okay.
There we go.
Let's try it one more time.
Yeah. So when you click share, choose the PowerPoint.
Yeah, you select the application you want to share, and then you click the share button a second time at the bottom.
Yeah.
Great. We are seeing it now.
Great. Perfect.
Perfect.
Thank you, Gwen.
Thank you very much. Is that in full? So let me just start slideshow. Right, there we are.
Excellent.
It's a pleasure to be with you today and to talk about a subject, in my opinion, that has outgrown governance manuals. No longer something we can fully address through just annual board evaluations, compliance checklists, or neatly drafted charters, as important as all of these are. The question today is, how should boards govern modern, publicly listed conglomerates in an age of super volatility, uncertainty, and shocks? This may sound academic, but I dare say to you, it isn't. It's a reality. For boards in the Caribbean, Latin America, Africa, and other small or emerging markets, this is an operating reality. And I'm sure this week you've already had proof of that. We work in economies exposed to foreign exchange constraints, climate events. We've seen recently natural disasters, geopolitical shocks, cyber risk, and shifting social expectations. And conglomerates, because of their reach and scale, sit right in the middle of all of that turbulence. A diversified group may span consumer goods, retail, automotive, energy, industrial services, financial services, logistics and technology, sometimes across several territories and currencies all at once. Each business has its own economics, its own risks, its own capital needs, and often its own culture, given particularly in the Caribbean history of how these conglomerates have come together. So the government's challenge isn't really how do we comply anymore. It's how do we govern complexity without suffocating the enterprise? How do we give operating companies room and flexibility to compete while keeping strategy, risk, capital, ethics, safety, and reputation under firm enterprise control? My argument is simple. The board of a modern listed conglomerate has to become far more than a body that meets periodically to approve things. It has to act as a steward of strategy, capital, risk, capital, capability, culture, and resilience. It has to learn to govern through a combination of decentralized, autonomous bodies and centralized integrity and assurance. For many years, governance assumed an orderly, rules-based world order. Boards approved strategy, management executed, committees reviewed controls, and once a year, there was a strategy or planning meeting. This model isn't good enough or fit for purpose anymore. We now live in a world of cascading shocks. A pandemic becomes a supply chain and capability crisis. A war becomes an energy and food price crisis. A cyber incident becomes a significant reputational issue. A leadership crisis becomes a price damaging event. A climate event becomes an insurance and continuity crisis. I call this super volatility, not simply that the world is changing, even if it's changing quickly, but that several rules and systems are changing together at once and interacting and affecting each other to create turbulence, uncertainty, and volatility. For a conglomerate in a small or emerging market, this is particularly acute. We're often price takers in global markets, dependent on imported goods, foreign exchange, and functioning infrastructure, and exposed to shocks we didn't create, but still have to find a way to manage. So the board can no longer ask only, did we follow the process? The deeper question is, have we built an enterprise that can see clearly, decide quickly, act responsibly, and recover strongly? Recover, it will have to. The best boards today are alert, they are curious, and forward-looking. Governance done properly is what lets an enterprise move faster with confidence, not slower with interference. Traditional governance has been episodic, built around meetings, but the risk-facing conglomerates, and I've listed all of them before, they demand continuous board awareness through not continuous board interference or control. There's an important difference. The board should not manage the business day to day. That's why you have management. But it requires an information architecture that tells directors what they need to know when they need to know it. The real question isn't how much paper is in the board pack. It's whether we know if the business is healthy and continuing to be so, and realizing its strategy, whether risks are rising or not, whether controls are working, and whether culture is sound and fit for purpose. To be effective, that means exception-based reporting. The board needs to know when performance falls outside of tolerance, when a safety backlog in a business is growing, when cyber vulnerabilities are remaining unresolved, even if minor, when a major technology or acquisition or build project is slipping, when sentiment is deteriorating, or when audit findings aren't being closed. And it needs triangulation, not just management reports, but internal and external audit and assurance. Whistleblowing trends become important. Site visits and independent assurance formed by the independent directors themselves. Trust management, but verify the system. I learned this in a big deal in my job in London at BP. A board that relies only on what's presented to it may discover too late that the organization was unable, and in some cases even unwilling, to escalate and raise issues to the right level. Every conglomerate faces a fundamental tension. Operating businesses need room to move. A food retail business, for example, can't wait for head office to approve every response to changing demand. A regulated industrial safety business has to manage plant safety and licensing with real specialist and often high-quality engineering expertise. The people closest to the market need to be able to act in response to it. But a listed conglomerate can't be a loose federation of businesses, each running to its own standards. The group has one balance sheet, one reputation, one shareholder base, one ethical identity, and often one brand that a single subsidiary can damage badly. In fact, sometimes it can be a single senior individual can damage badly. So the board has to ask, what should be decentralized and what must never be? This is where the modern conglomerate needs something like a hub and spoke model. The holding board, the hub, focuses on what defines the enterprise as a whole: group strategy, capital allocation, risk appetite, treasury, ethics, safety standards, cyber standards, executive succession, culture, and portfolio strategy. The operating companies, the spokes, run their businesses freely within these enterprise standards and guardrails. That sounds simple, huh? But it's hard to get right. If the center is too weak, the group fragments and risk builds up invisibly. If it's too strong, decision-making slows, and enterprise and ownership and accountability dies. My guiding principle or bias is decentralize execution, but centralize integrity. My guiding push commercial and operating action customer responsiveness and innovation down to where the knowledge sits. And honestly, that's not always in the boardroom, far from it. Keep capital discipline, ethics, risk appetite, data governance, cyber and safety standards anchored firmly at the center. There's an old phrase in governance: the board should have its nose in and fingers out. For conglomerates, this needs significant refinement and nuance, because the level of detail directors need depends entirely on the nature of the risk. It's not one size fits all. On commercial and operational matters, the board should stay, in my opinion, at the macro level. Directors don't need to know the daily inventory of every outlet. But where the risk involves significant or material consequences, legal compliance, financial integrity, cyber exposure, safety or reputation, the board must go deeper. In regulated industrial or manufacturing businesses, the board should know whether safety critical inspections are current and emergency arrangements have actually been tested. Lots of people have them, but they've never taken them off the shelf. In food businesses, whether cold chain systems are reliable and food safety audits are satisfactory. In heavy industrial businesses, whether the group is overexposed to obsolete inventory and manufacturer relationships are unstable or not. In an insurance or financial services business, whether underwriting standards are being maintained, reserves are adequate, and regulated capital ratios are secure and robust by testing. So the real test is not whether the board goes into detail. It's whether it goes into the right detail. A board that pores over every minor operating decision or just wants to know everything, in my humble view, is interfering. A board that avoids key safety, cyber, compliance, capital, and strategy detail is not meeting its stewardship requirements and could arguably be negligent. Conglomerates don't contain just one kind of business. That's why they're conglomerates. Picture a group that might include, for example, an automotive distribution arm, a food and retail chain, a regulated industrial manufacturing or energy operation, or just as easily, a manufacturing business and a financial services or insurance arm sitting alongside them. The contrasts are vivid and extremely varied, but the same principle applies wherever a conglomerate spans genuinely different sectorial logics. For example, automotive is capital-intensive, cyclical, and exposed to technology disruption. The shift towards electric and alternative fuel vehicles and depends on manufacturer relationships and inventory financing, often for long periods without recoup. Food and retail is a different animal. High volume, low margin, logistic driven, living or dying on inventory turns, cold chain reliability, and shrinkage control. A manufacturing operation runs on a different logic again. Long asset lives, engineering quality, and input cost exposure, where a single stalled supplier can halt its whole line of delivery. Apply the same governance lens all around them, and the board will fail. You can't apply retail logic to a regulated plant, underwriting discipline to a car dealership, or manufacturing quality metrics to an insurance book. A single return metric can hide very different risk profiles depending on which business you're looking at. That's why conglomerate boards need segmented governance, understanding the specific economics and risks of each business, knowing which indicators matter in each sector, and having directors with enough sector literacy to ask intelligent questions. This is why the issue of director orientation and knowledge becomes so important, particularly in small economies like our own, where director choice is often not as broad as it might be in other areas. The board needs to see each business clearly on its own terms and judge whether each still deserves its place in the group. Strategy needs the same kind of differentiated thinking. The old model of a 5-year plan renewed annually is too slow, but at the same time abandoning that discipline and having no longer wavelength plans and in-year quarter-by-quarter activity plans in the name of agility is just as dangerous. I find it useful to think in 3 horizons, governed concurrently rather than in sequence. Horizon 1 is the core business, the existing stores or factories, dealership networks, manufacturing lines, established industrial operations, and needs planning and performance rigor, discipline, efficiency, and return on capital. Horizon 2 is emerging growth, e-commerce and digital extensions of all kinds that are coming quite rapidly at us. New regional or international platforms for establishment of new lines or extended scale-up lines of business. Proven enough to be scaling needs, in my opinion, milestone-based funding and disciplined monitoring against unit economics and overall strategy. Horizon 3 is future operationality, automation, for example, AI-enabled logistics, new energy models, or small stakes and options in early startup stake businesses, and needs capped experimentation, agile modalities, and the willingness to kill projects that don't prove themselves. Often I find in conglomerates, you get this sort of 1-to-1 ratio of new things, new purchases, a recipe for disaster. The board's common mistake in governing all 3 the same way. You have to manage each horizon concurrently, but differently. Horizon 1 by performance and cash flow, for example. Horizon 2 by milestones, customer uptake, unit economics, scalability. Horizon 3 like options, small bets, capped exposure, fast learning, disciplined termination. Agility does not mean governance looseness. It means shorter, disciplined feedback loops, clearer guardrails, and faster decisions. In a conglomerate, capital allocation is where governance gets real. A conglomerate can generate cash in one business and deploy it in another. One of its great strengths and one of its great risks. Strong businesses can end up subsidizing weak ones for far too long. Legacy businesses survive on history and love rather than future value. Each major business in the portfolio should be able to answer a few basic questions. Why do we own this? What role does it play? Growth or forex engine? Cash generator, strategic option, or business in transition? Does it earn its cost of capital? If not, what's the credible path to getting there? And are we the best owner of this business? And most usefully, what would an informed outsider, if they look at our portfolio cold, think? That question matters enough that modern public boards should occasionally run what I call internal activist audits. Not surrendering to activist shareholders, but asking the hard questions before others ask them for you. Where is capital or forex trapped? Where is overhead not adding value? Where are returns inadequate? Are we simply too emotionally attached to an asset to see it clearly? Where is the conglomerate discount being created? And is that center adding value or just adding cost? Shareholders often bring a private equity mindset, speed, focus, cost discipline, impatient with bloated headquarters. Boards shouldn't reject that just because it comes from outside. But the board of a public company also has to remember its fiduciary duty. It acts for the company and the shareholders as a whole, balancing short-term value release against long-term viability and making sure cost-cutting doesn't compromise safety, compliance, or talent. Capital allocation also has an exit discipline that's often undergoverned. Boards spend significant time on acquisition processes, thesis, due diligence, pricing, approval, but governance of the exit decision is often less rigorous. Where does the board decide a business no longer earns its place? What triggers a divestiture review? The most disciplined boards apply the same rigor to exits as they do to entries, are willing to admit when they are the wrong owner of a business. This discipline matters even when a group is actively acquiring. When a listed conglomerate deploys substantial capital across multiple geographies in a compressed period, the balance sheet changes and the governance demands change as well. Higher leverage means less room for error. Cross-border deals introduce currency risk, regulatory difference, and integration challenges that aren't fully visible at the point of investment. They should be, but they often aren't. Active acquirers need to govern acquisitions as a program, not a series of individual events. A clear framework for how much leverage the group will carry, what the debt service threshold is, whether it will match debt and currencies, and integration milestones and synergy targets tracked with real discipline, not a story that evolves to the outcomes. I've seen profitable operating businesses whose contribution to the group returns were effectively neutralized by currency depreciation or trapped forex before the capital invested could even be recovered or dividends paid. What is the group's approved policy exposure limit, and what approves the hedging policy? These are board questions, not just treasury ones. New geographic markets present a distinct governance challenge of their own. Entering a developed or rapidly growing market from a small economy base carries risks that are quantitatively different from regional expansion. Different regulatory regimes, different consumer profiles, different competitive intensity, and different capital markets, all with additional volatility that you are not known in that market. You might be big in this market and got accustomed to it, but small in many extended regional markets. The board should have a clear view of what success looks like in year 3 of a new market entry, what the capital commitment is calling, and what conditions for scaling further versus stepping back. These are governance questions, and they deserve governance frameworks, not just management confidence. None of this works, by the way, if incentives pull you the other way. A business can improve in the short term, earnings by selling off businesses it should keep, buying others at too high a price, cutting maintenance, human resource, or technology investment. For a while, the numbers look better. But what's really happening is corporate decay. Long-term incentives should include return on invested capital, cash generation, safety and technology modernization, with malice and drawback where executives starve the business to hit short-term goals. In conglomerates, that decay shows up as outdated supply chain technology, a failure to prepare for technology disruption or transition. In a regulated or manufacturing business, an aging plant and deferred maintenance. In the financial services or insurance, a loosened compliance or underwriting standards, or an eroding capital buffer that only shows up once losses arise. In human resources, it shows up as gaps in critical technical or other skills, and leadership who are not developed adequately or are fit for purpose. The best response to shareholder dissatisfaction and activism isn't defensiveness, it's performance, clarity, and disciplined capital allocation. Oops, going backwards. I just like to, because it's a safety, I always take a plug for safety. A single generic risk discussion can easily become too broad to be useful. So you can't just bring a bank risk approach, as regulated and as good as that is, to a conglomerate. Different businesses live in genuinely different risk worlds. The risk vocabulary of a large industrial plant isn't the risk vocabulary of a supermarket chain, and neither is much like the risk vocabulary of a beverage business, an insurer, or a technology platform. The board needs to organize oversight so that each material risks gets the depth of attention it deserves. Some groups separate audit and risk committees. Others keep a combined committee, but use dedicated agenda blocks and lead directors with sector or risk expertise. The structure matters less than the discipline. High consequence operational risk must not get lost inside a crowded agenda. And internal audit needs to evolve to a regulated industrial business may need engineering and process safety assurance. A technology program may need independent technical review. The board shouldn't assume assurance is adequate simply because assurance exists, or audit exists, or findings exist. Let me be direct about safety. It is not a mere operational metric that gets delegated and forgotten. In high-risk businesses, industrial and energy, manufacturing, logistic, heavy vehicle operations, safety is a core governance responsibility. A catastrophic incident in a regulated industrial business can kill people, shut down operations, destroy trust, and damage the entire group. A safety failure can harm consumers and wreck a retail brand. The board doesn't run the plant and shouldn't manage every truck route or every safety or security activity, but it has to ensure that the safety culture, the systems, and the accountability are genuinely robust. An observation, I've noted that a lot of people like to get to the detail of that. But the real question is, are the systems working as you think they should be working? Boards need to look beyond lagging indicators, financial indicators, lost time injuries, and press for leading indicators, critical inspections, safety critical maintenance being deferred, or near misses actually being reported. Are people afraid to report them? Are training programs current? And are contractors held to the same standards? Paradoxically, a high-risk business reporting no near misses may just be a sign of fear, not excellence. Safety should not connect to remuneration. If an executive delivers record profit but tolerates unsafe operation, that isn't performance. It's borrowing from the future, and there should be safety gateways in executive pay. A board that wants AI but ignores technical debt is building on sand. AI requires clean data, reliable systems, and clear accountability. And it will magnify confusion rather than create value if you do it the other way. Directors don't need to become data scientists. Human accountability, bias testing, and ethical deployment. But they do need to ensure that the companies has rules for AI use, data protection, human accountability, bias testing, and ethical deployment. And by the way, you can't stay behind your employees. A lot of employees, because companies are not building the governance for this quickly, are exposing the companies to risk by using AI to help them on the side. As wonderful as that is, it could be a huge confusion to occur in the future. Boards need to get on with that. Finally, sorry. I think I'm coming to the end for those of you. I think I'll wrap at this point. In conclusion, I had a little slide on people and sustainability. Maybe we could talk about that maybe as questions. This is my little thesis. Let's bring this together in a short list of what I call practical takeaways. Clarify the role of the center. It has to justify itself by adding measurable value through strategy, capital allocation, risk, talent, and assurance, not just cost and decision delay. Define board reserve powers clearly, strategy, capital allocation, risk appetite, major transactions, CEO succession. And you will see from the earlier slide that I say, I think boards should know about the top 30 to 50 positions. And those positions don't necessarily have to do with hierarchy. They have to do with how critical they are if they walked out or they weren't fit for purpose in the business. And that's not always just the top 3 levels of the organization. Far from it. Define board reserve powers clearly. And then, of course, I believe that reputation also firmly belongs to the board. Segment governance by business model, so different businesses aren't governed with the same metrics or cadence. Strengthen the information architecture. Boards need exception reporting and triangulated assurance, not just more paper. Make capital governance rigorous, applying the same discipline to exits as to entries. Govern acquisitions as a program with an explicit leverage and currency framework. Elevate safer cyber and technology to genuine enterprise risks and opportunities. Govern AI deliberately with real guardrails. Redesign incentives to pay rewards for sustainable value creation, not just short-term value extraction. Take succession depth seriously below the C-suite and practice resilience. Require stress tests and crisis simulations before crisis, not after. The modern conglomerate is both powerful and vulnerable. Its strength lies in diversification, scale, capital, and reach. Its weakness lies in its inherent complexity and the tendency to opacity and the risk that weak controls in one part of the group can damage the whole group. That's why governance matters so much. In an age of super volatility, the best boards won't be the ones that predict every shock. I don't believe any board can do that in today's world. They'll be the ones that build enterprises capable of absorbing shocks, adapting quickly, and advancing with discipline. They'll understand the difference between decentralized action and centralized integrity. They'll ask the hard questions before the activists, the regulators, the competitors, or the crisis asks them. They'll support growth, but not growth without control. Pursue agility, but not agility without accountability. Embrace technology, but not technology without governance, and honor legacy without being imprisoned by it. Above all, they'll understand that the board's deepest responsibility isn't to protect the company as it is, but it is to help build the company the future will require of it. It is more demanding than box ticking, more dynamic than compliance, and more consequential than meeting procedures. For conglomerates in our region and across emerging markets, that stewardship of boards has never mattered more. Thank you.
Thank you, Robert. Now, before you go, there is a request to probably look at the information you would have prepared for people and sustainability. So maybe we could go back to that slide if you want to speak to it briefly, and then we'll come to the Q&A. That
That's
is
the one on sustainability. Okay.
yes, this one. And succession and so were critical topics that have been discussed quite a bit for this week
Well,
as well.
thank you. I kind of slipped past that, but it's very important. I think we need a more sophisticated approach to people. A uniform HR model won't work across these very different businesses. Some need scarce digital and technology talent. Others need a whole lot. Beverage or food may need frontline stability and regular upskilling and reskilling. A regulated industrial and manufacturing business needs high retention, engineering talent, and rigorous technical training. Financial and insurance services need scarce actuarial underwriting, risk, and compliance talent. That's hard to replace, particularly in this region. And particularly some of the technology skills are very hard to find. I've seen some of the businesses take over a year to find or replace those kind of people. Management should think about clear workforce strategy and portfolio terms. Where are scarce skills? Where will AI displace tasks versus augment people? Where is leadership depth too thin? Knowing and testing the adequacy of such systems is important to the board. And understanding root cause issues for problems in the business. I find in the Caribbean we are willing to point to the systems and to processes, but we find it extremely hard to deal with the people issues. One aspect deserving explicit board attention is succession depth below the very top. Boards regularly review CEO succession, CFO succession. It's often a visible risk, but the loss of a CFO, a divisional CEO, or critical technical leader or commercial leader can be equally disruptive to a business in a volatile environment. And the leadership pipeline these days is under extreme additional strain and pressure. I have seen boards whose whole succession coverage was genuinely robust at group CEO level, but had material gaps 2 or 3 layers down. Some, honestly, even right to CEO. Discovered only at the moment of pressure, the loss or the problem. I've seen people avoid dealing with people issues simply because there was no quick and easy replacement. The board should see succession health of, I just say, rule of thumb, the top 50 critical roles in the enterprise, not just the top 3. And they should know there is succession in place. I know that management don't like that, but I think it's a very big risk in the Caribbean. The board also needs to be alert to what I call cultural debt. We often are big on technical debt and process debt, but cultural debt, we are not. If transformation is pushed too hard without building trust, people become exhausted, cynical, or fearful. If AI is presented only as a cost-cutting weapon, employees may resist or disengage. If bad news gets punished, for example, by career trajectory change, Prof. Garrett, that's a euphemism for you go nowhere or you get transferred to Toko. If performance pressure overwhelms values, misconduct becomes likely. If PBT is all you measure, then that's all you get. If high-performing leaders are allowed to demonstrate poor values and leadership behaviors, but exceed commercial performance for long, the very fabric of the enterprise they lead can be destroyed. Culture is the invisible governance system. It determines whether people speak up, whether safety is real, whether bad news travels quickly or is deliberately suppressed. The board shouldn't discuss culture only in slogans. It should look at evidence, sentiment, turnover, whistleblowing trends, audit findings, leadership behaviors. In a conglomerate, culture has to allow for local differences while insisting on enterprise values that travel across every part of the group: integrity, safety, respect, accountability, and the courage to speak up and challenge. On sustainability, the environment calls for a pragmatic approach, moving from expansive, often over-expansive ESG language. That's called greening, by the way, to verifiable value chain, real accountability and steps. Sustainability oversight should be tied to real business risk, supply chain standards, and food safety in retail, emissions and safety in industrial, energy and manufacturing, the EV transition in automotive, and climate and credit risk in underwriting and lending for financial services and insurance. The board's role isn't to approve glossy claims. It's to make sure commitments are credible, doable, measurable, and governed to completion. Reputation now depends less on what companies say and more on what they can prove they do. Finally, the chair doesn't run the company, as most people in Trinidad seem to think, but shapes how effective the board can be, ensuring the board spends time on the right issues. The management is challenged but not ambushed, and that the board moves beyond paper compliance toward real stewardship. The chair, and where appropriate, the senior independent investors and independent directors don't understand why the group owns its business and how capital is. Let me just read that again. The senior independent director also engages major industrial investors before there's a crisis, not after. And I wouldn't say much more than that, but I have found myself in a situation where I had to go after the fact and speak to investors. And often, large businesses in the region don't feel the accountability in that way to shareholders. If investors don't understand why the group owns its business and how capital is allocated, don't fundamentally align to the strategy, the company becomes vulnerable to misunderstanding and activism of all kinds: state actors, private actors, public actors. Clear governance is part of the equity story as well. And that's what I intended to say on that. And I will leave it there. Thank you.
Thank you so much. So if you could take down your slides now, and I hope you have the next half hour to share with us still, because
I do.
excellent. We do have that half hour break before we get our first panel. Excuse me, but we can in fact use that time to engage with you, because I can't begin to summarize the many, many, many nuggets you have shared with us this morning that's going to cause us to rethink a lot of the way in which we view the board, and specifically directors' responsibilities when it comes to groups and conglomerates. So thank you very much.
Welcome.
So I'm going to let our participants know we are opening to the Q&A one time because I know that there are a lot of very experienced people who are here listening to you as well, and they would likely have some questions or so that they'd like to share. So I'm asking that they just raise their virtual hands or put their comment in the chat, and we'll come to it as appropriate. Robert, there's one thing that I want to start with, which is you looked at this issue of culture just now as we looked at people and the environment and all that. And we did have this discussion a little bit earlier in the week. Now, one of the things I saw from a PwC report on the survey of corporate governance in the Caribbean in different territories was that 46% of the respondents said they had no idea what the culture of the organization was. And so I was taken aback by that because I thought, but isn't the board responsible for the culture of the organization? So if you don't know what the culture is, then it tells me that at the board level, you're not really functioning as we expect you to govern the organization. But then we had some debate as to, is it the board that sets the culture? Because I'm thinking setting the tone means that's your culture. But then there were different views. Well, it's the CEO who sets the culture or management. So I just would like to get your perspective on that. And given how important you said understanding the culture is.
Yeah, I think it's these days it's a board responsibility to determine or set the cultural expectation and standard. I don't think that's something that's it's like boards approve strategy. They certainly are approving values and they're approving behaviors. So they in effect and how the board. I think sometimes it's difficult to get your arms around, and HR in the region, in my humble view, is still more bent on sort of process and employee relations as opposed to people and culture. A lot of people are getting the title people and culture, but I would say a real understanding and data-based understanding of culture is still a challenge for many boards, including boards that I've sat on, quite honestly. I think, and it comes to you in a lot of different ways and has to be pulled together. But I think the board ultimately cannot deflect or jump from or deny that it has the responsibility to ensure that the culture of the organization is the right culture, fit for purpose, and that it knows that what it thinks it is there. Um, and I think management are learning to get accustomed to the fact that independent directors don't only want to hear that from the management. They actually want to go around the organization in an organized way. They don't just turn up and knock on the door on Monday morning, but in an organized way, visit businesses site, talk to leaders, and all the time you're asking yourself the question, is the right culture, the culture that I think that I've been told is going on, is actually the culture that's out there. Um, I think that's a very important aspect. The other thing I'd say about culture is we like to dodge it, but it's not just it doesn't sit only in values, it sits also in the tone that comes from the top. And the top of an organization, people see the board. And so boards have to ensure that their behavior is also consistent with the culture that they wish to see around the business. They are the first place that people can judge that culture because they are seen. It's also it's managed by the CEO, but it's standard and its light is determined by the board, the collective board, and that often is a very hard thing. I've learned that being a chairman, in a sense you're amongst equals, and it can take a long time for boards to get their head around and the consensus to emerge. A lot of people rely heavily on the part of the director that says independent. Um, a lot of that then has to be brought together to become a board. So,
Yeah.
and I've heard Prof. Garrett on this a lot to be interested in hearing his view. But that takes a very long time. And public listed companies are at a disadvantage to say private equities when it comes to that. There's a much more direct line for private equities than they are for in managing these entities.
Yes. Thank you. So, Professor Garrett, we want to ask your thoughts on this. Kevin, I've seen your hand. We will come to you in a minute. Because Professor Garrett, for one thing, I repeat all the time, the fish rots from the head. So
Yes.
the role of the board in culture, setting the culture, understanding the culture, and ensuring that the way in which the organization is being run and managed is something that they've influenced in different ways. So we'd love to have your thoughts as well.
Thank you. I wasn't expecting to speak at this point. First of all, Mr. Briley, I really appreciate what you've just been talking about. Absolutely with you on it. I think what you were hinting at, particularly earlier on, is that we have reached, whatever you want to call it, turning point, inflection point, or whatever, in the roles of boards. And we are now seeing that well, what was mentioned earlier during these sessions, that profit is just not sufficient. We could put it another way. We have to have a surplus in any organization for it to continue. But the pursuit of profit alone is not there. It goes back to what my medical friends tell me about cancer. That the only thing that grows for its own sake and keeps growing is cancer. Everything else has a particular stop point, but not a cancer. It will keep going. And it's very interesting to me that the way in which we're having to face up to a world where it comes back to this polycrisis idea that the future directors can be nothing like the present directors, because I'm arguing that directing is actually becoming a recognizable profession. That means one has to do some training for it. And I'm always astonished that over 90% of the directors I meet all around the world never had a day's training in their life, but they're invited to join the board as an honor or sometimes as a penance. And they have to then make the best of it they can. And the back of my new book, Mike Mainetti says, and he's been the Lord Mayor of London and is a very well-known international scientist. And he says, in his life, most directors he meets are, quote, winging it. They're just about hanging on or keeping very quiet and hoping. So back to the point being made, the chair is absolutely crucial in trying to ensure there is a depth of not only knowledge, but understanding and a depth of humanity, which I think we're losing very rapidly. When I was going to give a little talk at the very end, I was going to say I've been very depressed recently at how much in America they are losing completely all sense of proportion in relation to the roles of boards, etc. In fact, they're actively destroying it, and we've seen that in Texas, and we've seen it in California to an extent recently in the Silicon Valley, where the whole notion of the legal entity becomes an AI agent, not a person. Very strongly argued for by some of the biggest names in the world at the moment, and really a way of destroying that. And I know that culture is the way in which the organization and the people within it are symbolized, the way their history is passed on from one to another, the way what is rewarded, what is not rewarded, what is laughed at, what is cried at, what is hidden, particularly. And it's this role of the chair, I think, is of increasing importance, but it in itself requires a deep humility and a modesty in being able to understand what they can do, but a great enthusiasm in seeing what the others can do with you. And that is, I'm just working on a new company myself, one in which I have an interest. I declare that, and it's only 5 people at the moment, but in 6 months, it's astonishing how each has grown very differently from the way we originally set up. It was mainly a technical setup, and everybody thought it was going to be all AI and all the rest of it. It is not at all. I'll tell you a bit more about that. But I just congratulate Mr. Riley on what he said. Absolutely 100% behind you, and long may you thrive, please.
Thank you. Thank you so much, Professor Garrett. Now, we do have some questions and comments in the chat. Kevin, I did see you put a comment in. So if you want to unmute and just very briefly and quickly, because we just have 15 minutes remaining in this, share your comment and a very quick question for Mr. Riley.
Hey, good day, everyone. And I promise you I'll be very brief today. I promise, not like the other day. But Professor Garrett brought up an extremely good point, something that's very important. And Ms. Rampersad, this was some time back, you and I may have reached out to you, put it into that very question as well, too, that people are selected to serve on boards throughout the length and breadth, whether it's public and private, and they have no idea as to what the directors do, what is corporate governance, all these things, and they are involved in strategic decision making, right? And that is a big problem we have here, but that's one thing. But let me throw this out to Mr. Riley, and even Professor Garrett can intervene too. We were speaking earlier, and you made mention about AI, and this is in modern times. So hear how this question goes that I came up with, right? With regards to the boards and corporate governance practitioners, are they prepared to oversee AI decisions in organizations in this modern time throughout the region? That's just my question I have for you at this time.
Thank you so much, Kevin. So,
I would say the answer to that is we are clinging on. If I'm honest, I think not a whole lot of the University of the West Indies has only recently is trying to put together an institute to support AI that is, in a sense, thinks from the region and its needs, and all of the inherent biases that AI that's trained on data from somewhere else brings to it. So there's not a lot of that yet seeping to firms. I mean, Sagicor, I'll call their names, I think quite enlightened, have taken quite a substantial position with UE in getting that institution going. And part of what it's trying to do is look at, not just an indigenous program, but how data bias, all the kinds of issues. But I would say the first thing we have to start is we can't necessarily, I am not one of those. I think you first have to embrace it, try to understand it, try to grow with it to see what it can bring and what its dangers and its upsides are. So a real risk conversation. Then I think you have to find a way to manage and govern it so that it becomes useful. You get the best use out of it, and you try it as best as you can to minimize. And part of that journey will be about building skills and competence in boards, in management, people being aware and needing to hire some of those skills into organizations. It's easy when you don't really know the back of the engine to look at a car on the surface and you drive it. And maybe that's how AI will be for most people. But in governance terms, you have to sort of understand what's under the engine, what's behind it, so that you can manage the downside as well as take the upsides. So I think it's a relevant conversation. It's a conversation that's loud, whether in the boardroom or in senior management you want it. Trust me, I talk to a lot of people and they are using it. And they only sort of come out of the AI closet when their organization sort of gives them formal access. So that means that data is seeping out of organizations, going into the world of AI, and who knows how it's being utilized.
Yeah.
We have some very unique data in this region that if we kind of brought it together, trained the AI on it, we might have some very unique approaches and solutions because we are unique people. So why not? So I think it's a journey, and it's a journey that we better embrace fast rather than just try to push back and say it's trouble. I want to make a point that Prof. Garrett made also as well. I think you're absolutely right, and I equate this issue of directors to footballers. We know a lot of great footballers. They've played the game. They've done wonderful jobs on the field, but very few of them make really good managers. What I mean by that, only one or two of them can cross the Rubicon. And one of the things I see a lot in boardrooms is people who were good managers, but not that they don't really understand what being a director is about. And they bring that managerial skill to the table. And of course, they tend to then want to manage, not that direct. It takes a long time. It's taken me a long time to even understand that difference. And one of these days, Kamala, I'd love to come back and give a talk on confessions of a manager who became a director without a lot of formal training. It's quite
Love
a
the
journey.
title.
It's quite a journey. And there's a lot of confessions, a lot of mistakes.
Good. We'll run a series on it.
If I'm honest, I'm sure if my corporate general counsel is out there, she's probably saying, what is he saying? But yes, I've made and continue to make a lot of mistakes. I've learned some of it the hard way. But there's a lot that goes into being a director versus an excellent manager. And the two are not the same. They are very different characters and people.
Yes, excellent. I love that. Confessions of a manager who became a director and mistakes we had to contend with. Perfect series. So we have a question in the chat from Alistair Rowe. Sorry, Professor Garrett, you wanted to say something?
Say book Mr. Riley now. Yes.
Book him now, yes. For sure, yes. Okay, so Alistair Rowe has a question in the chat, Robert. Alistair is from Belize. This is G.A. Rowe and Sons, which is also a conglomerate. His question, and because of a lot of the complexity you have described that boards of conglomerates contend with, his question is, what is the right frequency of face-to-face and virtual board meetings in your opinion? And what is the right time for each?
Okay, I'm going to give this this is not Robert Riley at Massy or former Republic or anything else. It's just my learning now and my observation. I am no longer that keen on a ton of hybrid meetings. As the chair, they're extremely difficult to chair. They are very difficult to, in a sense, read the room, to do what a chair should do at a meeting, which is to bring people in at the right time, to make sure that you are causing the conversation to be fulsome, but not dominated by any particular characters. And often what it leads to is that hybrid situation. Those who tend to get together, build relationships, and they talk outside the room together, and you end up with this fractionating of a board. My humble view is, if I was starting today from scratch at what I know, I would say, yes, hybrids have their place because not all of us can be in the same place at the same time, particularly if you want boards that have, geographical diversity. But a large proportion, and some boards are saying, well, couple meetings a year. I think it's a couple meetings a year should be hybrid, and a lot of those meetings should be in person. What they allow is during breaks for people to have, the argument that maybe the chair didn't permit at the table. It allows the chair to hear the argument that he didn't quite understand at the table. And it allows for a relationship that goes beyond business discussion. Think about it. A relationship that we have as individuals is not just about business transaction. It has to build trust. You have to kind of see and feel the person in very different set of circumstances. And I think going to 100% or lots of hybrid meetings is causing us to lose the human relationship that is the foundation of the trust that we want and the foundation of the efficacy of a board. And boards are harder than management. In a management, at the end of the day, you do have a hierarchy. Boards, they're really a group of equals, with somebody who is bringing them together and tacking them together. You might argue the chairman is the first. I could tell you I've heard some independent directors even argue that the chair is not the first amongst equals. You might have a veto vote in an equal lock situation, but that's it. So the dynamic of the board really depends on the relationships that people have, and humans haven't learned to do that fully, in my humble view. I am now convinced of that. By just being online with each other, it doesn't work.
Okay, great. And did you speak to the frequency of the meetings? How?
Well, I contend in the paper that boards have to have what I call this continuous conversation. So you need to have an information architecture that's not just about meetings. You have to be clear about how decisions get made, because even if a board were meeting once a month, 12 times a year, a lot of boards are doing half that, or realizing they need to go more that. Subcommittees are meeting, that kind of frequency as well. There just is not enough hours to deal with all the volatility and all the shifts and the speed at which things are going. So I contend that boards have to find a way to, in a sense, keep in touch with the business outside of meetings. So it's as important, the meeting, where a lot of things, come together, but you have to have this information set and exchange in an organized way. That's the real point I make. A lot of people want to be in touch, but it's a disorganized way. It's one director who calls all the time and actually becomes, in a sense, a bit of a nuisance. And sometimes disruptive. But you have to have an organized way, because at the end of the day, boards make decisions. Unless they've agreed some kind of hierarchy with the chair, that in between some decisions can be made. I have started to think that decision making, how it happens in meetings, outside of meetings, is a really critical thing that boards need to sit down and discuss. Just as there are delegations to CEOs, I think boards need to start thinking, while we reserve these powers, how are these powers enacted in crisis, in the need for a very fast decision that came out of a negotiation that you didn't anticipate in that way, or an earthquake where somebody has to respond, in fast with a lot of money. It could be a series of your buildings. It could be a building in Trinidad. I always tell people, we're in the earthquake zone. We talk about it could happen in Trinidad, where you get a catastrophe like that. How are you going to act? And so I believe decision making and dynamics go hand in hand. And we often talk about the dynamics, but not the quality of how decisions are really made by the board in and out of meetings.
Yes. Now, there's a whole lot more we can talk about, particularly because I think you have set the stage for us to recognize it. You said it. We need to really relook directorship as a profession, because it's really and truly no more a matter of just 4 meetings a year every quarter and taking the information that comes to you from management. What directors need to do today to govern in this volatile world requires ongoing education. And I think you said it best at the very beginning. Let me just go back to it very quickly. You said the best boards today are alert, curious and forward-looking. To be alert and curious means not reading the board pack when it comes. It is knowing the environment even before your board pack comes so that you can assess what is going on in a way that allows you to be forward-looking and to guide your management team. So there really is so much that we need to talk about, and definitely we will be inviting you back here at CCGI. It is 12:58, so we are 2 minutes away from our start time with our first panel here today, and of course we want to ensure that we have our panelists all ready and tested and able to deliver. So Robert, I want to thank you so much